Hi everyone, and thanks very much for tuning in to the latest Lawshare Q&A. And today I'm joined, or delighted to be joined, by our good and long-term friends Lockton, who many of you will know are leaders in the insurance market. And specifically, I'm joined by Vice President from Lockton, Marc Rowson. Marc, thanks ever so much for joining me today.
Thanks for having me today, Peter. Looking forward to it.
Excellent. PII renewals is a perennial issue for every law firm, every managing partner, senior partner that I speak to, and obviously coming off the back of a pandemic, I'm going to be asking Marc some questions about forthcoming renewals, what the market has in store, and how the guys at Lockton can help. So Marc, as I say, delighted to have you with me. And speaking of the pandemic, with the shadow that's been cast by that, how has the market changed, do you think, in the last 2 years? Is there any cause for optimism, considering this is, I suppose, one of the hardest markets we've seen in decades?
Yeah, look, I think you're certainly right with regards to that, Peter. It's been a really, really challenging 2 years for the legal community when it comes to professional indemnity insurance. One myth that I think is really important to dispel is that I've seen various comments around that the pandemic was the root cause of the market hardening, and it simply wasn't the case. So for me, the pandemic has probably accelerated and lengthened the hard market spike. If you look at an insurance market cycle, the softer market is always known to be far more longer in its duration, and a hard market tends to be a short, sharp spike, and then back we go to a softer market and more buyer-friendly conditions. But there were signs pre-pandemic with regards to claims trends and issues, insurer exits, that were causing problems for the professional indemnity marketplace, not just for the legal community, but also for the wider professional service space. Now, what the pandemic did and the uncertainty that brought about, it made things even more concerning for insurers. So the last 2 years have been difficult. We've seen significant rate increases, and I'm sure there'll be Lawshare member firms who, when they look at their insurances from 3 years ago to what they are now, it'll be night and day in terms of cost, and that is a factor, obviously, of the harder market conditions. But to your point around, are there reasons to be optimistic? I'm pleased to say I think there are. There are green shoots of recovery. We've got a very populous renewal date window now in April, and the early signs from what we're seeing is certain market stakeholders who for the last 2 years have been benign, if anything dormant, with regards to their appetite to take on new risk, they seem to be in a position now where they're looking to consider, albeit how much that they're going to put alternative terms on is still limited, but it's a good sign that they're starting to come back, and I think it will be slow and steady over the next 6 to 12 months, but it's positive sign for the buying community. I think secondly, it will be inevitable now, it's only a matter of time that we see new insurance capacity come into this space, and again what that will do, it will have a downward pressure on pricing, because insurers, number one, will come under attack under their own portfolios, where they probably had it a little bit comfortable in recent years because there just hasn't been the competition. Secondly, there may be business that they're not able to compete with the new entrants, so what they're going to have to do is, if they lose one, they're going to have to go and find number two. And it's the merry-go-round within the marketplace that will bring. So I think there's certainly reasons to be optimistic, but I do think we're not there just yet, but there are certain trends starting to emerge that, for me, over the next 12 to 18, 24 months' time, we're going to be in a far better spot for the buying community, which is great news and long overdue. And there's 2 points of caution on this, though, that I think the profession should be aware of. So first and foremost is the geopolitical situation that we've got, okay? So, and really where I say around that is the macroeconomic picture and what happens, okay? So Rishi Sunak was talking today and was talking around the economic uncertainty that's brought on by the current tensions. And where does that link to professional indemnity insurance for SRA regulated solicitors in England and in Wales? So where the insurers will be concerned is if we do go into or head towards a recession. If we look at the GFC in 2008-2009, there was an incredible uptick, primarily driven by lender claims against the legal profession, where we saw an incredibly high level of repo, right? Interest rates are just starting to creep up, So there's a little bit there. It's not to say for people to be alarmed and all the sort of pain is going to continue, but I think that's just something that people need to be aware of that could have an adverse impact around market conditions becoming more friendly more quickly. And I think the second part to factor in, again, is another economic metric, but if we look at the situation with regards to inflation, okay, we're 8, 9, 10%. I'm not sure what the most recent RPI figure was, but for me it's fundamental that law firms' revenues continue to also keep track with this, because from an inflation perspective, it's also the same for claims inflation. So a claim that we're seeing 2 years ago, the value of that is going to creep us as a result of inflation. Okay, so insurers, if the claims pot is just going to go up by way of what was £2 is now £3, okay, firms are going to have to keep their revenues going in line with inflation, which I know is not easy, but they're going to have to do it. Otherwise, you're going to feel the effect from a rating perspective, which I'll hopefully get a chance to come on to later. But it's just, again, just something to be aware of, that if your revenues don't follow that rate or close to that rate of inflation, PI could still hurt because of the claims inflation that insurers might see. So I hope that makes sense and you can understand that.
It does, absolutely. And touching on interest rates, I mean, can we talk about conveyancing? The SDLT holiday brought about a huge amount of stimulation within the housing market, and things remain strong even after its resumption. Is it right that firms engaging in conveyancing work generally will experience a greater increase in rate?
So, again, a correct point, and it's interesting because if I look at the renewal proposal forms that we're seeing at Lockton, we act for over 1,600 practices, so we've got a really good steer around this, and prospective firms that will ask us for alternatives. What's starting to flush through is the revenues that have come as a result of the SDLT extensions and the cut-off date. So a number of firms' financial years that had run around to the end of September, we're now seeing those revenues, and it's a good news story that revenues were up for firms, but a lot of the time that has been driven by residential property work. Okay, so insurers are looking at the number of transactions that were undertaken, and they're also looking at how much does that increase from the 1 year to the next. Okay, so it does have an impact. In terms of rate, what I haven't seen from insurers is a shift in their rate. So if they're saying to you, for every £1 of conveyancing income we want 10 pence of that, I don't think they're saying we want 11 pence or 12 pence now. But where firms are feeling it, for me, is if you did £1 worth of conveyancing work and now you do 2, rather than giving them 10 pence for the £1 of work you do, you're now giving them 20 pence for the £2 of work that you do. Okay, so I think with regards to that, the greater level of conveyancing work, it is from how insurers price, it's the most expensive area of work and the risk that they seek to retain. So you will see not necessarily a rate increase with regards to that, but the cost of the premium, if your fees have gone up and your property work has increased, you will inevitably be ending up paying more premium at the moment. And I think the second point on that, with regards to the stamp duty and just the amplification of work that came with that, and hopefully long may that continue for the profession, insurers are also concerned. So they're still, I said about that it would take 6 or 12 months for things to improve on my last point, and a big part of the reluctance for insurers to be growing in the space of residential property work. So a lot of what we're seeing at the moment, there's a reticence to grow if a firm's got sort of over 25-30% of property exposure. Right. Certain insurers are saying that's too much, anything more is too much for us at the moment. We don't necessarily want the risk and what they perceive as the volatility on the portfolio. They are still concerned with regards to, you won't yet see if any particular claims trends will come through from this spike in work, but they have got concerns around pressures on fee earners, remote agile working at the time of the pandemic. So there's a number that are still taking a cautious approach. I think in the next 6 to 12 months, if there are no trends that come through on the claim side, and insurers are constantly monitoring this, then I really do genuinely believe that there's going to be more of a thirst for residential property risk from some of those stakeholders that at the moment are taking a very, very cautious approach because of their concerns that there may well be a amplification of claims that have come in as a result of a greater volume of conveyance transaction being undertaken. I'm of the optimistic view that I don't think this will occur, but I also understand that underwriters as custodians of their company's capital, it's going to take a brave underwriter to take a punt on this when we're still very, very in the relative early infancy of the fallout of what's actually happened post-completion on those. So in the next 6 to 12 months, I think we will see braver underwriters, hopefully supported by data that suggests that there isn't going to be a spike in claims.
I see. A slight diversion, but interesting points as well that you made about people working at capacity at times, very, very busy, a lot of work, and also looking at perhaps supervision as well when people are adopting agile working practice. So food for thought, I guess, for many of our members, because I know that when I'm out speaking to Lawshare members, these are some of the questions, some of the concerns that they have. So it's interesting to see how that feeds back into the market and the thinking of the insurers as well. So yeah,
most certainly, and I think the point on agile working, there's not one insurer yet who I've seen that's got a real concern or an issue with agile working. Firms seem to have really taken to it, and it seems to work for the firms that we've spoken to, clients of ours. It strikes the right balance, and I'd also question, consider a number of insurers are working on an agile basis. There'd be an element of hypocrisy if that was a big factor. But what they are looking to see in the question sets that they're asking, and I'm sure a number of Lawshare member firms have noticed this on their renewal, whichever insurer they're with, is that they're trying to drill down into what does a supervision look like when the working model is slightly more agile. So that's the key question for them: is there still oversight? Is there still the proper pathway that if someone needs support and guidance, that they can get an answer, and they're not just going to go away and sort of do the work and go unnoticed if there's a problem. So I think it's something that, really good point, and insurers are not concerned about it at all. I think what the crucial bit for them is how is this being operated at management level.
And have you seen an increase in personal guarantees?
So it's interesting. So there's two insurers that, as at the time that we speak here now, that have been insistent upon partner guarantees being requested with regards to the professional indemnity insurance. So if we look at the embryonic stage of this was very much a byproduct of the initial part of the pandemic. So we've cast our minds back, which is now I think nearly 2 years today. We look at, there were certain insurers that they were petrified because of the runoff exposure on the insurance policy that they provide. If a firm collapses, they still have to, the insurer at the time has to provide the runoff coverage, even if they don't get the premium. Okay, and at the time there were a series of insurers who were lobbying the SRA with regards to that runoff provision, and they were basically going to the insurers. This is the first few months before, when nobody knew what was going to happen. Okay, and they were saying, look, this is really uneasy for us because there's 9,000 or so firms that we insure. If a significant proportion of these firms go under as a result of this pandemic, we're going to be left with all this runoff liability, and a very good, because the firms have sadly gone under because they don't have the revenues, we're also not going to have the runoff premium there. So that was a concern. The SRA, quite rightly, in my opinion, they did the right thing and said, now is not the time for us to review our runoff language. For the record, I do believe it needs to be reviewed, but that's a conversation for a different day. But they did the right thing there and went, now is not the time, because their mantle at the end of the day is to protect the consumer, and that was the right thing to do. So the majority of insurers went, okay, we understand, and we were also at the time, this was around the July, so we were 4 months into the pandemic, and insurers were starting to see actually this was not as drastic as we were first fearing in April and May. Firms seemed to be doing okay, and we're not going to have this cliff edge scenario that we were worried about. There was one insurer in particular who really had their bit between the teeth, and I'm of the view what they wanted to do, they wanted to put this in place, and they hoped that the rest of the insurance market was going to follow, and it didn't happen. It didn't happen that way, and a number of insurers, for me, took a more pragmatic approach, and they would look at firms on an individual basis and look at the solvency and the strength of the solvency of the business, but they wouldn't blanket to say that, right, we need partner guarantees to be signed. And a lot of these partner guarantees are for people's benefit, are for any unpaid excess or runoff premium in the event of a firm closing. So there are two insurers that still continue to offer these partner guarantees. Also not offer, it's particularly the wrong word. Request partner guarantees. But it's quite interesting that one of those we're starting to see a loosening, because they did lose business as a result of the guarantees, because certain members of a limited company, and it was only for limited companies or LLPs, partnerships and sole practitioners, they weren't requested upon them, but they are joint and severally liable. So that's why a partner guarantee wasn't being requested of those individuals. But LLPs, limited companies, we've seen scenarios where insureds were paying more premium to not have the partner guarantee put upon them, because there just wasn't a consensus at partner level that they were happy to personally guarantee in the event of the demise of a firm. So I understand why certain insurers are asking for it, I do, but there is an element of commercial pragmatism here that is also at play. So thankfully we've not seen an amplification and an acceleration with regards to the partner guarantees, but they haven't also completely gone away. So yeah, we are where we are, but my view is I think that we will see a reduction rather than an increase over the next 18 to 24 months.
Thanks, Mark. So, in your view, should firms seek to limit their liability in order to manage their risk, and will that have a positive impact on premiums?
So it's a question that we get asked regularly. Okay,
Yep.
so a very common question that I will have, Peter, is that I'll be sitting with a client, or I'll receive a call, and they will say, look, we only buy 3 million of professional indemnity insurance cover because that's our compulsory limit, that's what we have to buy. But we've been asked to be instructed on a sale of a property for 5 million, for instance. Okay, we really want to do the work. There's a good revenue stream for this. What should we do? Should we limit our liability? One of the big barriers to entry for some firms who just buy the compulsory limit and then get the odd one-off transaction. When you buy excess layer cover, you don't just buy the excess. You can't get a specific transaction insurance. Okay, you have to buy excess layer cover for the period of 12 months. All right. The other thing to factor in is you've got the limitation period. So professional indemnity is a claims-made policy. So it's not, the claim isn't the responsibility of the insurer when the work was done. It's the responsibility of the insurer when the claim is made. So if you've undertaken this transaction on the 5 million property, you buy your excess layer for the year, you don't then renew that policy, there's an exposure for the practice, because there's another 5 years around limitation where they're exposed. So, and also excess layer costing is quite, as a result of a hardening market, is quite expensive. So depending upon the profile of the firm, it could range from 2,000 per million to 5, 6, 7,000 pounds per million. So depending on how much more coverage you need, you've got to weigh in that. You've also got to weigh in that you really should keep it in place for 6 years. So a lot of the time in those scenarios, firms go, actually, this is the revenue that we're going to get against the insurance cost. It just doesn't factor in, right? So one of the things that they will say is, well, maybe we can limit our liability. Now, for me, I think it's one area that definitely firms should explore, because I think it protects their position. Even those that buy a greater limit of indemnity above the compulsory limit, having that limitation of liability provides a protection. But I think for me, the most important thing on this is it can't just be hidden in the terms of business, right? So let's play that forward, and there is an issue, and a defence is, yeah, but we limited our liability, right? I could still see an issue with an insurer having to defend the claim where if it's not documented and it's not been made clear to that said client and they've suffered a loss, I don't think that it's going to stand up as a defence. If you're going to limit your liability, have a conversation, be transparent with the client, but also have something documented on file that highlights that they accepted and were aware of the impact of that. So I think it's definitely a lever and a measure and a tool to use. I'm certainly an advocate of it, but my other aspect on this is be clear and transparent with clients at the same time. Don't just let it be bundled in with the various bits of paperwork that are there and not point out what that means.
A lot to consider, but yeah, thank you for that, Mark. What are the emerging claims areas that are causing insurers concerns at the moment then?
Yes, so we've had 3 or 4 years now, and I'm sure many Lawshare members are fed up of hearing this, around buyer-funded development. So it was a huge issue, off-plan, a lot of the time, where the crux of this claims were that not always overseas, but there was a high proportion of overseas buyers were they were funding the development of a premises. They'd sometimes pay up to 50-60% deposit to help fund this, and the offset of that was they were getting a property for slightly under market value because they were involved in the development. Now there were a series of developments that went under, and there were tens and tens of millions of pounds of claims that are being made and still ongoing now against the legal community. The charge being that their risk warnings were not strong enough, and we're talking thousands of claimants. Okay, so that was a big area, and it's not gone away, but a number of these are now notified, but they're now, the litigation and the dealing with the claims are going on, so the pain is still going to be felt as these claims start to settle and the insurers have got to start signing the checks. Okay, so that's not a new emerging area, but still a really pertinent point. The big, I suppose, areas of interest to insurers and what they're keeping an eye on. I think the first point is contested probate. Okay, it's nothing new, but again, we're seeing a growth in the number of claims. The profession seem to be, or certain elements of the profession seem to be mobilising and understanding that there's money to be made. An element of cannibalism, really, where certain members of the profession are going after their peer group for this. Okay, we've got a situation where the family structures are becoming more and more non-nuclear. Yeah. Right, you've got more disgruntled non-beneficiaries, as it may be, and asset values, like I said at the top, are increasing. Yeah. So actually, there's more at stake and there's more to fight for. Right, so there's a perfect storm that's building around this, and a number of these claims, insurers are able, and law firms themselves are able to bat them away and defend them. But there's a cost that comes with this. A lot of these are being funded via CFA as well. So there's a cost element, and sometimes insurers are just going, do you know what? If we fight this, we probably will win, but the costs that we're going to incur in fighting these claims are going to outweigh the commercial aim of just settling these matters. Yeah. Okay, so I think what's interesting from the insurer side is the continued growth in the number of notifications that are coming into this space. Okay. And as I say, a seemingly a mobilisation of some of those litigious law firms that will openly look to target members of their own peer group. So that's an area of concern and of monitoring for insurers. The second point here is this is more abstract and probably intangible, but I know from the conversations we're having with proposed entities, there is a growth in class action firms that are seeking to start. There seems to be an interest from across the pond. A lot of what we're seeing is for individuals in the UK teaming up with successful class action firms in the States and looking to set up. Okay, now at the moment, there's maybe nothing there that's going to impact professional negligence actions against solicitors, but I'm also of the view, maybe this is a terrible analogy, but if you haven't got sharks in the water, you're not going to get bit. If sharks start to enter the water, there could be a greater risk. Yeah. And I just think it's interesting if you look at the legal landscape, of which Lawshare member firms know far more than me, as I'm a stakeholder in the industry, but I'm not actively in it. But I believe we're going to see a forever and ever increasing litigious environment. There's a lot of capital coming in around litigation and continues to. And I think one of the areas of concern from the insurance community is, well, is there going to become a time where, again, I use that word mobilise, but there's going to be if there's an issue that does arise, there's going to be a number of entities that are going to look to seize on that from a revenue perspective, which could be at the detriment of a law firm or a series of law firms for negligence claims. So I think that general environment, I think, is something that is also of concern to insurers. So for me, they're the two most notable areas. There's always going to be trends, and there's always going to be your normal claims that were there 20 years ago and will continue to be there 20 years later. And I think that the big concern of them is the asset values, and what a claim cost to settle 5 years ago is now could be more expensive in the years ahead. So, but for me, they're the two real areas of, I suppose, interest and what I would say for firms just to be guarded. And I think it goes back from an advice point. just document your files, keep records, so that in the event that someone just tries to throw enough mud at the wall in the hope that some of it will stick, that you're not in the position where you can't defend yourself.
Yeah, good advice. So then, speaking of advice, what would your top tips be for firms ahead of their renewal then?
Right, okay. Top tips, other than a large glass of the choice of their tipple whilst they're completing their forms. Or actually, sorry, I shouldn't say that, after they're completing their forms.
Yes, quite.
I think, look, on a serious note, prepare early. Again, it's a little bit cliche, but this is still a seller's market as we sit here today. It's not a buyer's market, and I've seen examples of firms who have just left things a little bit late, and I get it. There's been a lot on the pressures of running a business in a pandemic, right? Insurance is one facet of an ever increasing burden on business owners, but prepare early. Don't leave it too late. Okay, take the time with regards to your presentation. I wrote a piece for Legal Futures recently where I was saying that I've had people contact me and say, what was the point of spending all this time on this renewal presentation if our price has gone up? It's not necessarily the approach or the position to take on it, because actually by doing that work, I know the cost is going up, but you've actually probably prevented an even greater increase.
Course,
so I think you need to come and look at it from that angle, but be proud of the business, but really take the time in your presentation. It's your shop window, right? So you've got to use it. You've got to use it wisely. So that's another big tip for me. If we're really going into the nitty gritty, claim summaries. I've seen it. So firms will wait to get their forms done, then they'll give the proposal form to their representative, and then there's another week waiting for claim summaries. So get those claim summaries at the beginning of the process, not once you've completed the form. It might seem like a really silly point, but it's actually really important, particularly when we're in the environment that we're in. You may get a shock. You may have a trusted advisor that hasn't got the distribution to market that they said they had, and you suddenly get your renewal terms at the 11th hour, and you haven't got time to react. And I know there's instances where that's happened over the last 2 years. Okay, so I think timing's really important, and I think it leads me on to my last point. Okay, I would naturally sit here and say that Lockton are a good broker to deal with, and we'll always look to. It's something that we pride ourselves upon, is we're not going to waste people's time. Okay, we act for 1,600 or just over 1,600 law firms in England and Wales. We're very proud of the fact that we act for that many, and of course we would like to act for more. But what we will do is have a very full and frank conversation at the start of the process, so whether we can add any value or not. Okay, I have real sympathies for the buying community within this space. The barriers to entry in terms of what I do and what we do are far too low. Okay, it is difficult for a buyer to differentiate between one broking house to the next. There's an element of transactional advice that comes in with this, and in the current climate, it's really important. You may have good relationships with the people that you've worked with for years, but I would be drilling down, working out which insurers can you approach, but more importantly, which insurers can't you approach?
Okay, yeah.
Because the reality is there's a number of brokers out there that can't do a full market exercise, okay? So where can you go? More importantly, where can't you go?
Yeah.
Secondly, are you dealing with these insurers directly? Because again, barriers to entry are low. There's layers sometimes in terms of an access to an insurer. So you'll have a broker that will be dealing with another broker who's then talking to the insurer. So you've got two on the chain. There's a bloated chain, and messages can get lost in translation. And in an environment where it is difficult and a challenge, even in a good environment, I wouldn't recommend it. But really pose that question of your current representative, right? Are you dealing with insurers directly, or do you use the services of another broker? And I think finally, my last point is, don't hesitate to have a conversation with somebody else. But make sure it's a reputable broker who's got a broad access to market directly. Because I'll be completely honest with you, it tends to be the ones who won't tell you what you necessarily want to hear, but what you need to hear, who aren't necessarily desperate for the revenue that comes with a placement of insurance, that are actually going to give you the right advice and the advice that may well be beneficial to you. So for me, I think that's again a rather long-winded answer from me, but I just think really do take some time to properly understand, well, what are you actually doing for me, and what are your limitations, what can't you do, and then it becomes a question of, well, what can I do to address them? And at Lockton,
so asking the right questions.
Yeah, and at Lockton we can't do everything. Okay, so we can. I was speaking to a Lawshare member firm just before on the way up here. Okay, and he's called me and he said, look, this is what my situation are. My renewal terms have gone up significantly. This is what situation I'm in. And my conversation with that individual, we don't act for them. And I said, look, first and foremost, I do feel for you, but I don't think in the current climate those terms are completely unreasonable.
Right.
I gave them the second piece of advice around what they could do, which was there was no engagement with regards to us with this. It was what they could do with their current providers to hopefully help. So just to say, it's advice that's given that's ultimately going to benefit that firm. And thirdly, we basically left the conversation to say, if you really need me, I can see what I can do. But the reality is actually where we are at the moment, where you are, you're probably in the right spot, right? So from our side, it's about giving the advice that's impartial and that's beneficial to a firm. So that would be my point to Lawshare member firms. I don't want to say like it's a sales pitch here, but we generally just want what's best for the firm. So if we can help, we'll say we can help, but just give us an opportunity and we'll tell you whether we can do it or not. And in the current climate, it might be that now is not the year, and we're quite happy to wear a number 12 shirt, but for that peace of mind, you know, we're happy to have a conversation with all firms.
Marc, always good to speak to you. A fascinating overview of what we've experienced, what we're likely to experience, a real good sort of practical guidance there. Good luck to all those who are renewing, and as Marc says, Lockton always there, willing to speak to any Lawshare member. We'd be happy to exact an introduction if you do want to speak to Marc and his colleagues at Lockton. Happy to do so. You know the email address, lawshare@jmw.co.uk. Myself, Stuart, the rest of the team, more than happy to exact an introduction or answer any questions that you may have that have been sparked by this conversation. I hope you've enjoyed it. I'm very grateful to you, Marc, for joining me today, and keep your eyes peeled for the next Lawshare Q&A. Thanks very much indeed.